Every single time you borrow money, you are renting it, and almost nobody explains what that rent actually costs you over time. We think of debt as a number, the price on the tag, the amount on the loan. But debt is not a number, it is a machine, and once you see the gears turning inside it, you will never look at a balance the same way again. Start with the simplest idea, because it gets buried under jargon. Interest is rent. When you borrow money, someone else is letting you use their capital right now instead of using it themselves, and the fee you pay for that privilege is interest. That is it. It is the same logic as renting an apartment instead of owning one, except the thing being rented is purchasing power. The lender hands you the ability to buy something today, and in exchange, you agree to hand back more than you borrowed, spread out over time. Once you frame it that way, a loan stops feeling like free money and starts feeling like what it is, a rental agreement with a countdown clock. Now, here is where most people get tripped up, and it is not their fault, because the system is built to make this part fuzzy. The sticker price of something you buy on credit feels separate from the interest rate attached to it. You see a purchase, you see a monthly payment, and your brain treats those as the real cost. But the annual percentage rate, the yearly cost of borrowing expressed as a percentage, is the actual price tag. A rate that looks small monthly can compound into something enormous over a year, and a rate that looks scary as a yearly number can feel invisible when it is chopped into small monthly bites. The mechanics of money hide in that gap between how a cost feels and what it actually is. Learning to translate a monthly payment back into its true annual cost is one of the simplest, most powerful habits in personal finance. This brings us to what I call the minimum payment trap, and it deserves that name because it is genuinely a trap, engineered almost perfectly to look harmless. A minimum payment is designed to be just enough to keep an account in good standing, not enough to meaningfully shrink what you owe. If you only ever pay the minimum on a revolving balance, illustratively say the rate sits somewhere around 20% a year, that balance can take well over a decade to disappear, and by the time it is gone, you may have paid back 2 or 3 times the original amount, all in rent for money you borrowed once. The trap is not that the math is complicated. The trap is that the math is invisible on a monthly statement. You only see this month's tiny payment, never the multi-year shadow it casts. To understand why early payments barely move the needle, you need to understand amortization, which is really just a fancy word for how a big loan gets unwound over time. Picture a large loan, like a mortgage, structured to be paid off in equal monthly installments over many years. In the earliest years, the vast majority of each payment is interest, rent on the huge chunk of money still outstanding, and only a small sliver actually reduces the principal, the original amount borrowed. As the years pass and the principal slowly shrinks, the interest portion shrinks too, and more of each payment finally starts attacking the core debt. This is why someone can pay on a large loan for years and feel like the balance barely moves. It is not a glitch. It is the machine working exactly as designed, front-loading the rent and back-loading the ownership. Given all that, it matters enormously what the debt is actually for. There is a real, useful distinction between debt that helps build something of lasting value and debt that only drains. Borrowing that funds an appreciating asset, or that increases your ability to earn, or that creates something still standing after the debt is paid off, can be a reasonable tool, a bridge across time. Borrowing that simply funds a purchase that loses value the moment you make it, with nothing left once the balance is gone, is much closer to pure drain, rent paid for something you can no longer even hold. Neither is automatically good or bad in every case. This is general education, not a verdict on any specific decision, but the distinction is worth sitting with before you sign anything. When someone is carrying several debts at once and wants to climb out, there are 2 well-known mechanics for doing it. The first pays off the smallest balance first, regardless of its rate, because clearing an account entirely creates a quick win and real momentum, a psychological engine that keeps people going. The second pays off the highest interest rate first, because mathematically that is the rent costing the most per dollar, so eliminating it saves the most money over time. Neither approach is universally correct. One optimizes for the mind, the other for the math, and understanding both means you can choose deliberately instead of drifting. None of this is about shame. Debt is a tool, older than currency itself, and tools are neutral. It is the terms and the awareness that make the difference. The whole point of seeing the machinery, the rent framing, the real annual cost, the slow grind of amortization, is that once you can see the gears, they stop controlling you quietly in the background and start becoming something you can actually work with. Again, this is general education about how these mechanics work, not personalized financial advice for your specific situation. This is Money Mechanics. One money rule at a time. I will see you tomorrow.